Let's welcome Bank of America Chief Economist Mickey Levy. He is here with us in New York City. And from Washington, Columbia Business School professor Charles Calomiris, who also serves as a consultant to the Fed. Gentlemen, good morning. Charlie, I'll begin with you. We were talking about the fact that, and we have been for several days, signals from people like Janet Yellen, Dennis Lockhart, Charles Evans speaking yesterday that maybe the Fed is moving to a more accommodative stance at its next meeting in less than a couple of weeks. What do you expect?
Well, I fear that they may. I don't think it's wise. It's a horrible risk-return trade-off. The idea that the Fed could be anything significant as a contributor in monetary policy to easing the pain right now, I think is a silly idea. But the Fed is so politicized that the desire to appear that they're doing something is so strong, that's the big risk. I think that we have to distinguish monetary policy from crisis management policy. When Ben Bernanke says the Fed remains ready to act as needed, I think that's a serious and important point. In other words, dollar swaps with the ECB as necessary to manage crisis in Europe, that's an entirely appropriate Fed policy action. But more quantitative easing is a horrible idea. Let's hope that our very highly politicized Fed manages to avoid it.
Mickey?
Good morning, Charlie.
Good morning, Mickey.
Let's put it another way. So you start off this show talking about central banks to the rescue. What are they capable of doing now? The U.S. economy is growing modestly. All of the inhibiting factors are non-monetary in nature. The financial system is gagging on excess liquidity. Bond yields are already low. More quantitative easing wouldn't help.
But Charlie made the point that they have to appear that they're doing something, which gets at an interesting point. Aren't they supposed to respond to a weakening economy, not necessarily to markets?
Well, the issue is the specific answer to your question is yes, but I would argue that if you look at the weaknesses in the economy, they're not monetary in character. There are other factors. So you could go through QE 3, 4, 5, 6, and you'd still have the mess in mortgages and the adjustments in the economy that are inhibiting things. Ditto in Europe. Do you think Draghi or anybody believes that ECB easing is going to help the European situation? The only area where I see a reason to ease more is in Japan, where you actually have deflation.
So Charlie, are the financial markets just deluding themselves into believing that stimulus, is some kind of a tonic for what's happening to the economy, to Mickey's point, and to your point, because you said it would be silly for the Fed to embark on some new round of quantitative easing?
I think that's a distinct possibility, and I completely agree with what Mickey said. But I do want to add one point. The Fed still has a nuclear bomb. And the nuclear bomb, which some economists are openly embracing, is that the Fed would target significant increased inflation and commit to growing its balance sheet for the foreseeable future at a particular annual rate. That would have a significant short-term positive effect on, let's say, mortgage foreclosures and other sorts of things, but it would come at a big cost. It's a very bad idea. So I think the other thing is that there's this sort of hidden conversation in the background of whether the Fed might choose inflation. And let's remember, the Bank of England has been above its target rate and not really responding to bringing inflation down for some time. There is this sort of question of whether central bankers are using these announcements to sort of explore the market tolerance for an openly inflationary policy.
Well, central bankers, unfortunately, it's hard for them to have long-term outlooks given the short-term pressures. Something like a QE3 is the short-term heroin that the market wants to see in order to get risk on and push the market up. I mean, you sit in the middle of Bank America, you know what it's like when there's an announcement like that and boom, it's risk on 5 minutes later. Isn't there an incentive, a push to get the market really confident and in taking risk?
Well, but there are costs to doing so, and the Fed is always, and the other central banks are always weighing the costs. The the central bank shouldn't be kowtowing to the markets. It should be setting a strategy based on its long-run objectives. And once again, I think, while I agree with Charlie, there may be some members of the Federal Reserve talking about a higher inflation target. I think there are others within the FOMC that are talking about the limitations of monetary policy and how much it can do. So I think it'll be a nice discussion the Fed has. But once again, I think when you look around the world, I think too many market participants perceive that the central banks are all powerful, and they aren't. Once again, all you need to do is look at what's happening in Europe, look at the factors that are inhibiting economic growth in the United States, and you come up with the conclusion. Sure, you want the Fed to help out where it can, but it's really limited at this point.
Charles had said that the nuclear bomb is for central bankers like the Fed to choose inflation. Mickey, you just said that deflation is the only reason to ease. Bernanke had said yesterday in the testimony that deflation is not a main concern. Yet the 10-year yield is at about 1.5%. Oil prices continue to slump. They're in the low 80s, and there's plenty of supply out there. Is deflation looming over us more than central bankers are likely to admit?
Certainly not in the United States. I mean, you have nominal spending growth in the economy well above potential. So you do not have insufficient demand relative to productive capacity. There's the probability of deflation is exceedingly low. Now in Japan, you have insufficient demand, you have deflation, and BOJ Governor Shirakawa has emphasized the need to targeted inflation to 1%. So they definitely need to, quantitative easing would be in order for the BOJ, but not the other central bank.
Charlie, we're talking about all of these extraordinary types of policies. What is it that has the central bankers of the world so worried? What are the known, unknown horror scenarios right now?
Well, I think obviously Europe and China are the two big stories. China is a long-term risk that we've known about for a very long time that's getting worse. Growth slowdown with all sorts of weaknesses in the banking system and the state-owned enterprise structure. But Europe, of course, is the more important proximate risk. My own view is Spain is an eminently solvable problem. It's a matter of allocating the loss within Europe in a sensible way that does not undermine the sovereign debt capacity of Spain. This is solvable. It is not something that we should have taken this long to deal with.
But it's not solvable by central banks.
Charlie,
it shouldn't be.
Charlie,
it shouldn't
and Mickey
be
both.
solved by central banks.
I want to go back to this remark that you made, Mickey, about how the central bankers, whether they be on the Fed or the ECB or the Bank of England, should not be kowtowing to the markets. To Charlie's point, though, what signals do the central bankers need to respond to? It seems that they have no choice but to respond to the markets because the data lag too far, perhaps, in places like Europe. We don't really know how severe the banking crisis is in Spain. We can only really read what the bond market there is telling us to a certain degree, and maybe we get these lagging data on deposit flows and the like. You know, how do they struggle with that? And I'm interested to hear what both of you have to say.
Well, with regard to the economy, of course, the Federal Reserve, has its forecasts of the economy, and it follows the data. It's supposed to be forward-looking, but I must say, in the United States, the banking system is sound. In Europe, not so. Okay, so certainly when it looked like there was a short-term funding crisis looming the end of last year, the ECB stepped up with its LTRO to provide liquidity to the banks. So the ECB right now, because there is a banking crisis and the central bank should properly play the role of lender of last resort, the ECB has to be more attuned, somewhat to the market, but also to stresses in the banking system.
And Charlie, how attuned in your mind do the central banks need to be to the markets?
I didn't hear that.
Mickey was saying that, yes, in Europe, perhaps the central bankers need to be slightly more attuned to what's happening in the markets. What do you say?
Well, of course. But I think Mickey's right. If you expect the ECB to deal with the allocation of loss within Europe, that is, a key problem is getting German banks to write down some of the debt they hold in Spanish banks to recognize that they've made some bad investments to ease the pressure on the Spanish sovereign, or alternatively having Germany come in and assist Spain. I mean, you know, the point is mechanically there has to be a political decision. The ECB can't fix that. And if it isn't fixed, it will just get worse and worse. And there's really not much the ECB can do about this fundamental insolvency problem. In fact, they've already put themselves hugely at risk in places like Greece of experiencing significant loss.
Charlie, thank you very much for joining us. That is Charles Calomiris of Columbia Business School in Washington, and here in New York City, Mickey Levy, the chief economist at Bank of America.